This is Jim Landman in Kaufman Hall's Thought Leadership Group. Welcome to our Summer Rating Agency Update. Housekeeping items before we begin. First, you may ask a question at any time during the webinar using the Q&A function on the webinar platform, and we will respond to your question as time permits. Second, a recording of this webinar will be sent to everyone who registered within the next day or two. And finally, just a reminder that our panelists will be reconvening for a rating agency session at Kaufman Hall's Healthcare Leadership Conference, which will be held on October 19th and 20th at the Four Seasons Hotel in Chicago. Registration information is available on the Kaufman Hall website, and early bird registration with a $300 discount ends at the end of this week. It's now my pleasure to welcome back our three panelists. Eva Bogerty, Associate Managing Director at Moody's Investor Service, who is having some technical difficulties and will be joining with an audio connection only today. Susie Desai, Senior Director at S&P Global Ratings, and Kevin Holleran, Senior Director at Fitch Ratings. Today's webinar will be moderated by Robert Turner, a Managing Director and leader of Kaufman Hall's Treasury and Capital Markets practice, and Lisa Goldstein, a Senior Vice President in our Treasury and Capital Markets practice. And with that, I'll turn the webinar over to Lisa.
Well, thank you, Jim, and thanks to all of our friends from the rating agencies for joining us today. Susie, Kevin, and Eva coming in through loud and clear. Welcome to our seminar, our webinar today. We're delighted to have you. And hello to my co-moderator and better half today, Robert Turner. So we thought we would start off today by asking each of you, we'll go around the Zoom video just to give us an update on year-to-date upgrades, downgrades, affirmations. So Kevin, let me start with you. Do you want to give us the rundown from Fitch?
Sure. Let me give you a little level set as well too, and always first and foremost, thanks for having me, and great to be here today. And we're gonna have some fun today. Last year, just a level set, we had 13 downgrades, 10 upgrades, so not a real significant difference between the two. But I'll say that 6% of the portfolio at that time was on a negative outlook, and I think that's where the dynamics are taking place. Year to date through the end of June, and this is where we have a decidedly negative tilt. We have 12 downgrades to 4 upgrades. So it doesn't take a rocket scientist or a bond analyst to know 3-to-1 ratio is pretty negative tilt. But I'll tell you that 3% of our portfolio is a negative outlook. So I think clearly what we've been doing is resolving a lot of those negative outlooks, if you will, from the prior year this year. And if you had to look at some commonalities, and I'll probably say this a lot today, it's, does it, in our opinion, have the characteristics, the credit of a lower rating? And we think it's going to be there for a while. Do we fundamentally think it's lowered a notch and it's going to remain at that level? So it's not this, rapid descent we saw in 22, but attenuation of stress and strain in 23, and the expectation it's going to stay there for a while, I think has been the common theme on those downgrades.
Got it. Thanks. Okay, Eva, the voice from above.
From beside. All right. Well, thanks for having me. Sorry to be just a voice, but happy to be here. Yeah, I mean, absolutely more downgrades than upgrades this year. We are at about, I always like to start with affirmations because that's what we do the most of. We're at about 80 affirmations, 25 downgrades, 4 upgrades year to date. So, and I do think that, we're pretty similar to what Kevin said, is like, we're repositioning for fundamentals over the long term. And I think that largely that big wave was the first half of downgrades. I think that will slow throughout the second half. That pace will slow throughout the second half of this year. That was really reflecting the quarters of 9/30 and 12/31, which we all know took a big hit on both operations and cash and liquidity. So definitely overall, more still a relatively stable sector, and more affirmations, and I expect more affirmations to come. I do think our outlooks, our negative outlooks are higher over here and haven't changed much year over year. We usually use that to indicate, if XYZ occurs, a downgrade could happen or an upgrade would be likely to happen. So it's kind of a shot across the bow, a cautionary in either direction indicator.
Got it. Okay, thank you. Susie.
Yes, and thanks again for having us. I think we're kind of similar trends. We have affirmed or maintained about 136 credits, so it's about 69% of all the actions we've taken. So still majority have been affirmed. That said, the downgrades relative to upgrades, we had about 23 downgrades, or about 12% of all the rating actions, relative to 8 upgrades. So much lower there. And like everyone, similar trends. And on the unfavorable outlook, so those are mostly going to negative, we had about 24, which is about 12%. And the favorable were much smaller at about 5, and that was about 3%. And it is quite different from last year. I kind of pulled last year's trends, where we maintained about 79%, downgrades were 7%, unfavorable 5%. So definitely a little bit more action earlier this year. We do have a fair number that are still on negative outlooks. I didn't pull the latest numbers, but it was, for standalones, it was around 20%. And for systems, it's a little bit lower at about 10%. So still, potentially some pressure over the next year or two. And I know we'll talk a little bit about expectations kind of going forward. But I think, there are credits that we are maintaining, but I think we are now monitoring the recovery period. But, we're not out of the woods yet.
Got it. Wow. So everyone's been very busy, that's for sure. That's the common theme. Susie, let me just pick up with you. Let's talk about perhaps near-term expectations. Your team put out a report recently where you said, we expect the period of rapid deterioration is likely behind us. Welcomed news. Absolute rating actions could begin to slow. So can you expand on that? What does that tell us?
Yeah, so, I think what we did at the beginning or towards the end of the year, beginning of the year, is we started triaging, and those credits that had material operating declines and liquidity issues were probably already, many of them were maybe weak for the rating, or maybe had gotten weak for their rating or had other structural issues. We took those actions and we got those where we, like Kevin said, where we think they're going to be for the foreseeable future. And we're not saying we're out of the woods, because like I said, we have a lot that are on negative outlook still, but we're not maybe on that free fall that it felt like we were seeing for many places towards the end of the year, beginning of the year. And depending on other credit characteristics like enterprise strength and balance sheet metrics, we're able, I think at this point, to monitor recovery and see where things are going to level out. And I'll caveat all of that with the fact that our committees are, I've said this before, but they are becoming tougher. For many places, we might see losses or even weaker earnings, but not what we would necessarily expect for a particular rating. So as we go through the remainder of this year and into next year, I think we may still see, a negative bias for our outlooks and our rating actions, but hopefully it won't be at the pace as we monitor this recovery. But it's obviously a difficult environment to predict.
Susie, I just have to follow up. Rating committees getting tougher. Does that mean they go longer? Does that mean more information is needed, or the decision-making process is tougher, the outcome?
I think all of the above.
Okay.
They are longer, they get, because you're trying to assess the entire credit characteristics in the profile, and is this now resting at a different place, for the foreseeable future, or are we starting to see some signs that it could get back, closer to where it was prior to where all this weakness came? So it's all of the above, I would say.
Okay, got it. Just trying to, open up the kimono, right, of a rating committee. Eva, let me go back to something you said. You said the word repositioning. So when you look at all the rating activity, particularly the downgrades year to date, could one say that there's an effective effort to move the portfolio down by a notch? Any thoughts?
Lots of thoughts. Yeah, no. The answer is no. That is not the intention at all. You know, I talked about how many we'd affirmed or maintained, and that is, you know, always the bulk. I'm looking back over, you know, some historic years. 2008, we had 58 downgrades. 2009, 56. You know, year to date, we're at 25. Last year, we had 27 total. So, you know, this is not. It's not a deliberate repositioning of the entire portfolio. It is really done on a case-by-case basis, exactly what Susie said, looking at the fundamentals. How has this entity shifted relative to its peers in its rating category? So, you know, absolutely not a deliberate shift idea to shift the medians. And, you know, interestingly, I've been looking at our medians over time, and it has really, it's very stubbornly A1. And that's where we were in that 2008, 2009 period with those downgrades, and that's where we are today. So.
Got it. And Kevin and Susie are nodding in agreement, you know, on the, you know, this is not a deliberate move to shift a whole portfolio down. Kevin, let me circle back with you. What, you know, high pace of downgrades year to date, as you mentioned. What are the key common themes behind those?
I think the things that really stand out, maybe two or three. First of all, is continued very significant operational losses in 23 year to date. That's what we've really seen. And that everyone, you know, gets a pass in 2022, but everyone's allowed to have a really bad year. We've seen it for a variety of reasons. IT install a strike, you know, in or out of network, things like that, and you move through that and you emerge, you know, victorious and triumphant at the other end. So 2022 has kind of come and gone, and we're in 23. And if people say, yeah, it's shaping up to be just as bad of a year as 2022 was, and our pace of climb out of this is slowed down, I would say that's number two. So, you know, not everybody gave us a V-shaped recovery, but a lot of people gave us a U-shaped recovery. Some of these now are turning into like L-shaped recoveries. It's going to take us a long time to dig out of this. That starts to go, you know, ding, ding, ding in your head. The credit now is, again, sort of that fundamentally reset at a lower level, and it's going to be there for a while. So size of the loss in 23, the pace of the recovery is slowing down, and you can't ignore the fact that the balance sheets are weaker. And I think all three of us have stripped out all the MAP funds. It's not I've repaid the MAP funds or anything along those lines, but the balance sheet's lower, which means the cushion is lower than it used to be. So a lot of people say, well, you know, look, what will forestall a downgrade?
Yeah.
And the real simple answer is always, you know, a fortress balance sheet will do that, you know, but we're running out of fortress balance sheets. They're further and fewer in between.
Well, that's a very good point. So Kevin, when does the benefit of the doubt run out?
I always wish I could say 78 days and just give you a real hard answer and everyone could just go with it. The reality is you can see by our downgrade to upgrade ratio year to date, you know, again, 12 to 4 is a 3-to-1 ratio. The benefit of the doubt is starting to run out for a lot of the credits. So again, they've come into us again. They said, I'm not going to pull out of this nearly as quickly as I thought, nearly as robustly as I had hoped. My balance sheet's a little bit weaker, and I'm planning on losing just as much this year as I did last year. Benefits probably run out for that particular credit. If you give us a not quite as bad, again, I'm going to pull out of this pretty quickly, and we can see a pathway through. Benefit will probably stick, particularly if there's that, again, that fortress or a very strong balance sheets in play. But I would say, look, if I had to characterize it, time is running out for credits. I think in 23, this is that make or break year.
Got it. Okay. Wow. For all that said, each of you have had some upgrades. If you strip out the upgrades that were due to, say, a note substitution merger, is it just that much harder to be upgraded? Susie, let me ask you, you know, one would say, you know, have you moved the goalposts back when it comes to what does it take for an upgrade?
We don't think the goalposts have moved back. We're probably still sitting maybe at the 5 or 10 year 10-yard line of the opposing side. I'm probably butchering the analogy a bit, but you get I think we're just farther away from the goalpost if you think of the upgrade as getting to the goalpost. So it might just take more or longer to get to those goalposts. And just given what the external environment is right now with, we haven't solved labor, there's still higher expenses. Even if you've kind of pulled agency out, you're still sitting on a higher cost structure. There's still a lot of investment that has been deferred, so that needs to be done. I know our economists, are projecting higher interest rates for longer, so borrowing is going to be expensive. And while our base case doesn't have a recession at this point, S&P's base case doesn't have a recession, if businesses are in a more, slower environment, maybe they're not as interested in sort of the premium increases that the insurers are turning around to ask for because the hospitals need it. So it just could be a tighter environment to get to that upgrade. So it's not that the goalposts have moved, it's just maybe harder and may take longer to kind of get there.
Got it. Thank you. Okay, Robert, over to you.
Great. Susie, question for you about covenants. I think our perspective is we see a number of clients encountering challenges with respect to covenants. I'm sure you are as well. When you see a covenant violation, does that automatically result in a downgrade from your perspective?
Yeah, no, the answer is no. I think the cases where we have seen downgrades because of covenants, maybe twofold or two different ones. One is where things are moving fast, maybe not a great market position, maybe an overbedded community, significant issues with liquidity, don't have forbearance agreements yet, don't have waivers. There could be some kind of liquidity crunch with debt that could cause something to move quickly. We have other credits where we've maybe downgraded just because that one covenant isn't the only thing. It's just looks, back to the we just think it's going to take longer to get to where to get back to the rating level. And it just needs to be downgraded. So I think there's like a couple of different ways that maybe downgrades have happened for those covenant violations. Where we may not take an action is when there has been, maybe it's the first year, they're starting to look a little bit better. It's probably not a repeat thing. They've got a great position in their market. They have their waivers. They've got, they've had the discussions at least going, and they're getting some signals from the banks and their trustees that things are going to move in the right direction. That's where we may not be taking a rating action necessarily just because of a covenant violation, or if it's something related to unrealized gains and losses or something like that that was just out, or investment earnings that really sort of took it to a different level. So a couple of different scenarios where we have taken it and where we have decided not to maybe take it.
That's really helpful. A lot of times documents will prescribe that a consultant is called in to do an independent consultant's report. We just published a thought leadership piece. It's on our website. It'll go out, I think, to our subscriber base or client base either later this week or early next. Are you seeing consultants' reports? Do you ask for them? How important is that to your process?
We do like to see it, and we want to get a sense of kind of what are the kind of levers to pull to get things back to a better kind of position. So it is helpful to see those. We may not hold off on what we need to do just because we don't have it. If we feel like we have enough information that we can make a call on the rating, we may go ahead and move it even if we don't have that report. It's nice to see, though. It's nice to get that report.
Great, thank you. Kevin, what are you seeing with respect to the willingness on the part of investors or banks with respect to waiving or amending covenants?
Yes, so far, we haven't seen anybody, and let's just be honest, we're talking really about the atom bomb here, acceleration, so to speak. We've not really seen anyone accelerate and say, I want out of this deal, give me my money back, et cetera, et cetera. So I think the willingness so far has been similar to the financial crisis. So long as the institutional characteristics are strong of the organization, the balance sheet's still holding up. So the covenant popped, if you will, have been on the coverage. And yes, sometimes now we're about to get into that second year. So how much progress did you make from the first pop and the consultant call in, and where are you in that second year? Are Are you again trending upward, trending positively? I think again that willingness starts to get extended a little bit, like that shot clock we talked about a little bit earlier. So I have not knowingly seen anybody say, hey, it's time to accelerate, we want it out and we're done. I think it's been pretty even-handed on in for a penny, in for a pound. We understand what's going on, and so the willingness is there. I would say, I just wanted to piggyback on something Susie said, and I think you were asking about, just because they pop a covenant doesn't necessarily mean a downgrade. I completely agree, but look, we see the same thing, right? As the math sees this, so it's not uncommon for us also to downgrade when there's a covenant pop, because something fundamentally might be going wrong as well too. So it's not a fait accompli, but it often is an early indicator sometimes.
Yeah, we think of it as sort of the canary in the coal mine, right?
Canary in the coal mine, absolutely.
Yeah, exactly. Well, look, I would assume that if someone's not getting a waiver, they're not successful. That is a credit negative, right?
Yeah, I mean, look, you never know exactly what's going to happen until it happens, right? But again, most of us immediately go towards the acceleration. And depending upon who you are, if your cash is less than debt, then someone is going to get, if you will, burned holding the bag, so to speak. If you have 100 million in debt, you got 50 million in cash, and there's two bondholders each with the same amount, whoever gets out first gets most of the money, that sort of thing. Whoever gets out second gets burned, and that almost always means that the remaining credit that's left standing is going to be lowered down. So I think you've seen us actually use, and I don't have the exact number in front of me, more credit watches than we have recently, because I know when I finish my financials, I'm gonna pop a covenant violation. I'm in, as Susie mentioned, I'm in discussions and negotiations. I think I'll get that waiver, but we don't know yet. So we might take it down a notch, take it down a couple of notches, and put a credit watch on there, because if that waiver doesn't come through, yes, it could spiral out of control pretty quickly. We've seen that happen years past, not recently, but certainly there are some case studies to look at that we've all been a part of, unfortunately, in our careers.
Yeah, I think we're on watch for that as well. I think by and large we've seen credit banks willing to play forward and grant waivers, et cetera. I know their return expectations go up as credit quality deteriorates, and so that's a sort of a conversation we're having with clients. But I think, like you, we're on watch to see what's the willingness on the part of those credit counterparties. Eva, a question for you. What do you wish clients would do better with respect to disclosing their covenants? What additional information would you like to see?
Yeah, sure. In the analyst dream world, I think, I've seen, first of all, kudos to you, Kaufman Hall. I've seen your covenant sheet, and I think that is amazing. The matrix you do, I think, for an analyst, standardization of covenant reporting in quarterlies, full calculations, kind of bullet points on how covenants interact, or how different legals interact, or your different agreements interact with each other, in terms of, is there a cross default? What is your understanding of what is an event of default? What is your understanding of the remedies? It's always good to have that up front. We're obviously doing our read for our understanding, but it's always great, great to see it all spelled out so that we can compare notes. And obviously in an ideal world, we'd see quarter to quarter how things, in a situation like we've been in over the last year, quarter to quarter, how things are progressing. Even if it's not a quarterly reporting, what is, what's the progress towards it?
Sure. Question for you, Eva, and I will probably ask the others to comment as well. I guess we're curious to hear, maybe, are you getting phone calls from investors? Obviously, no need to name names on any side of this, but is there sort of an increased level of query from investors about credit quality or covenants in particular? What do they ask about when they call?
Yeah, I mean, absolutely is the answer to that. And if they're calling pretty regularly, even if a report isn't out, if they're picking up the quarterlies and seeing something, they're calling us to get information about, what is our understanding of the event of default? What are the potential liquidity levers. Do we know what management is doing to remediate now ahead, or, you know, are they seeking a waiver? I mean, we can't answer all of these things if they're not out there in a report, obviously, but these are the questions we get. Is there cross default? You know, yeah, and what have management's actions been to date? So,
Susie,
yeah.
Susie, are you getting those calls too? I would assume so, but I'm just curious to hear any color commentary you have to offer.
Yeah, I would agree. We do get more calls just in general, like as soon as the quarterlies hit, like, what do you think about this? And is this what you guys expected? And so that's not necessarily the covenant issues, but just in general, we get more calls like after those quarterlies get disclosed. I think it's the stuff that Eva talked about. It's just clarification on things like, will this cause this, and what are the banks and what? So I think those tables again, where it's delineated clearly, like what all the different covenants are, what exactly the calculations are helpful, because I think there is a lot of confusion out there when you have all these different bank debt types of things. Just a couple of other things that we have heard on the bank debt is that there seems to be like, you know, some of the banks are starting to say, not necessarily, it may be related to this or not, maybe other things, but maybe not willing to renew some of the bank debt that's outstanding. So we're hearing a little bit more about that, but that's, I know, kind of tangential to this question. So
Yeah. Kevin, anything you'd add on the topic of inbounds from investors?
No, just that they've picked up, and I think a lot of times it's that they want a second opinion. Look, this is how I'm seeing this. This is how I'm looking at it. How are you looking at it? How do you see this? Am I reading this the right way? You know, a lot of times we get you know, buy side folks that aren't healthcare experts, right? They just pick up any sector that they get assigned to, and really looking for a little guidance, not on what to do, buy or sell. I'm not going there, but a little guidance on, am I reading this audit? Am I reading these quarterlies right? Am I seeing this the same way? So call us a second opinion sometimes. But in terms of pure volume, absolutely, it's been very active buy side inbound calls for the last couple of 3 years now, really.
and I think their biggest question is the question you asked. It's like, how patient are you going to be?
Yeah,
They try to ask.
That's going to be everybody's question. Yeah. Question for you, Kevin. How willing are you to forbear or hold off on a downgrade if it causes, if there's a rating trigger in the covenants? Like if that by itself were to, you know, precipitate further, you know, cascading effects within the documents, does that affect you in any way?
Now, I hate to be the skunk at the picnic here, but no. Look, if it's like baseball. If you see a balk, you call a balk, even if it walks home the winning run.
Okay. Yeah.
If we see downgrade, take the downgrade, and if there is aftermarket effect that causes it again to sort of spiral lower, that's what happens. But we would never, absolutely not, hold off on a downgrade, knowing that there's triggers in the documents. Again, sorry to be the bearer of bad news on that one.
Yeah.
I think to that point, when you're doing those disclosures too, it's helpful to know what the other rating agencies and outlooks are, because that goes into like, if a rating downgrade from someone else is going to cause something to happen, that's going to affect our view of the credit too.
That's a good point. Well, let's change gears for a little bit and talk about consolidation. I think there's a lot of activity in this space, and would love to get, you know, a conversation built out around this topic. You know, Kevin, would be interested to get your thoughts and have you talk a little bit about the increase in cross-market mergers. What's your perspective about that?
I think we're just in that period of time in healthcare in the sector that is the dominant form that's being allowed. So I'm not here to say it's good or it's bad or it's ugly, but from a legislative standpoint, federal and local, there's a lot of pushback on M&A activity and a lot of heightened eyes looking at it, and most are looking askance at it, saying we don't approve this, we think it's anti-competitive, it's monopolistic, et cetera, et cetera. So that's become the norm, and we can all rattle off a litany of these that have taken place. I'm sort of fascinated by them if I take a step back and look, because that's not the usual, it's not the norm, it's not what I'm comfortable with or familiar with from a bond rating agency perspective, or when I used to do consulting and we did mergers to trying to find those synergies that you can get, I think, more easily in local markets, so to speak. So I think it's, you know, most of these are still in their relatively nascent stage, but I expect we'll see a whole lot more of them go forward. And I expect that, like I say, that will be for the time being what drives M&A activity. That's the kind that we're going to see. Ultimately, I think, the goals being held out there, are not so much cost savings. That's not what we hear there. Most of it's based around quality, misrepresentation in healthcare equity, all sorts of things. Very lofty goals to, I think, fix and make better here in the U.S. And I think, again, looking at it from the sidebar, I don't see a lot of rating activity, a lot of rating changes based on it, and I'm kind of very interested if they'll achieve those goals. So more to come on that, I think, but definitely a trend that will continue.
Eva or Susie, anything you'd add to that? I know I'm putting you on the spot a little bit, but just curious if you have any thoughts you'd share.
Yeah, I mean, I agree with Kevin, and I think that certainly in this environment, everyone's going to do what they can, right? And if this is what's available and other things, we're seeing other creative solutions are what's available, then that's what's going to happen.
Great.
Yeah, I would agree. I think it's just, they are very strategically focused mergers. It seems like, there may be some cost savings, but that's not the driver of the merger. And I think, the jury's out of it, where it all lands. But it does seem to be a big push on like sort of the quality, the value-based kind of care, moving that needle and being able to do that, theoretically with a bigger system and having some expertise on that.
Yeah, great. Interesting. Thank you. We're going to maybe try to fix Kevin's audio a little bit. Bear with us. It's Murphy's Law is here today. But let's see if this helps by turning off the camera. Kevin, I guess now that we've turned off your camera.
Now that you can't see me.
Now that you can't see you, maybe talk about a little bit about how you incorporate merger announcements into your rating decisions. How do you all think about that? Maybe just sort of talk through that for us.
Sure. Now, I mean, first of all, Ty's coming off. It's crazy town here without the camera. But fairly simplistically, and I like it that way, to be very honest with you. So let's just back up. Like letters of intent, memorandums of understanding, wonderful news, great to read it. But we don't do anything from a rating perspective. I don't have any numbers on this, but I'd say anecdotally, half of them fall apart. They just don't go anywhere. So we're not about to put people on a rating watch or do anything there. The next biggest step is a definitive agreement, and we typically don't do anything even at the DA stage, even when it's finalized. And we are very happy, by the way, to keep obligated groups separate so long as they stay out there separate. We kind of follow the document. So if I'm bondholder of System A, and something goes wrong and you pop a covenant, my fixes, my remedies are to go to hospital system A. That's where I get paid back from. That's where I can accelerate. It has nothing to do with hospital system B that you might have just merged with. So we're happy to, and vice versa. So we're happy to sort of keep those things separately. Only when the two entities, if you will, get commingled or intermixed in such a way that you can't unscramble the egg anymore, that's when we have to, my word here, harmonize the rating. Are they the same? Are they a notch in between? Whatever they might be. If they issue debt together, for example, that's a bellwether event. We've got to have same ratings now on all three entities, so to speak. The NewCo, hospital system A, hospital system B, if those obligated groups are still outstanding, or if they become imperceptibly different in a marketplace. They're in the same market, and this is not going to happen as much as we just talked about, but they're in the same market. They've merged the boards, they've changed the logo, they've changed the names. A bondholder has every reasonable expectation now to assume System A and System B are the exact same entity. Then you'll see us sort of quote unquote harmonize the rating at that stage of the game. So we really kind of follow the documents up until they're inseparable, basically speaking.
So curious, if you do keep them separate, right, which is absolutely a choice, and System A, sees a deterioration in the quality of the credit, does that cause you any concern for System B? Are you worried about some sort of contagion, or how would you think about that?
Certainly not immediately, and certainly not with the kind of mergers that we've been talking about. We've been seeing these cross-market mergers. So again, follow the legals, follow the documents, and unless there's proof that, like your phrase, the contagion is spread, and I think hospital system B is now infected and coming down as well too, we conceivably could end up with 2 different ratings on 2 different obligated groups that have merged. And that's absolutely possible underneath our viewpoint and how we look at M&A activity.
Yeah, great. Susie, you're still standing. Thank you for your video solidarity. Maybe talk a little bit about sort of how your rating methodology works with respect to mergers. Curious to have your thoughts on this.
Yes, and then there were 3, as they say.
Yeah, right.
Yeah, so I think similarly, letter of intents, we don't, we might write about it in the report, but we don't really bring it into the credit rating view yet. When they get to the definitive, we may change the outlook depending on how we're seeing, and that kind of gets into how we treat, when 2 entities come together. So we have what's called group rating methodology criteria that helps us kind of look at that and evaluate that in terms of, when two entities merge together, what to do with the rating. So when they come together, we basically mush it all together and we look at what the system looks like and what is that rating. And based on our view of that, and so we're looking at the credit characteristics, the business profile, the enterprise strength, we come up with a rating for the system. If it's all going to be one big obligated group, basically it's the majority probably of the system, cross guarantees even, it's very simple. You kind of keep one rating there based on what that system rating is. That's the easy way. If they have separate obligated groups, we use that group rating methodology criteria to determine the relationship of the groups to the overall system. And that means the system's overall strategy and goals, and how do those 2 entities kind of relate to that. And I'm not going to get into all the details here, but we have different levels of that relationship. And so if these 2 entities that came together are equally important to the overall system strategy, goals, what they're trying to do, we do harmonize the ratings. They're both core to the system. If one was gone, like it could change the overall rating of the system. If it's less of a tight relationship, or it's a smaller entity that's kind of off to the side, and you could foresee a situation where no one's going to necessarily go out of their way to support it. It might have more of a looser linkage, and we still might be giving it some uplift or some credit based on management and governance or something to that effect. But it may not have the same rating necessarily of the bigger obligated group that's maybe the majority of the system. So without getting into too much criteria speak, we have criteria that helps us evaluate that. Certainly can talk through that if there are any other credits that are going through this and how, but basically it's kind of, you're looking at the importance of those obligated groups to the overall system and trying to determine, does it match, should that be at the same rating or should it not, and maybe a notch differential. So that's kind of how that is how we look at mergers and different obligated groups, if there are different obligated groups that remain.
So then in a rating report, would you reference the group rating methodology? And that's sort of the process you just outlined.
Yeah, we basically say they're core to each other, so they're the same rating. And we have credits that have had 3 different obligated groups in certain cases, and they're all the same rating. And we have where there's 2 obligated groups and they have different ratings. So it's
interesting. Okay, great.
Susie, just one question related to that. Do you wait a certain amount of time, let's say obligated groups remain distinct, before you move to your group rating methodology?
We try to, like when the merger happens, we try to get in there we try to get a conversation, a meeting scheduled as quickly as we can.
Got it.
We understand it's not going to happen on day 1.
Yeah.
Sometimes it takes a couple months to get that. So we try to be patient. We obviously want to get information that can help us determine our view of that group rating methodology or where different obligated groups live. So there's no set timeline, but we try to, at least start having the conversations as quickly as we can.
Got it. Thank you.
Eva, talk about, if you would, how Moody's incorporates this into their analysis.
Sure. So like everyone else, multifaceted, maybe more closely following what Kevin said, we certainly don't do anything at LOI. We'll look at it and what we think the credit impact might be internally when we hit definitive agreement stage. And when it is actually finalized, We too will mostly follow the documents. If it's two separate obligated groups, it will remain two separate obligated groups. You know, we like to say everything's always on credit. It may not impact the rating, so we will look at the credit impact for both. And I think that, you know, one standout scenario is because obviously there are multiple different scenarios here, right? But if it's a very large obligor and a small coming together, and if there is you know, very clearly no way to unwind the agreement and there's explicit support written in, then I do think that that will give and the smaller entity is rated lower, I think that will give some, you know, bottom to that rating, right? We won't bring it to the same level. They're two separate obligors, but it does, we have to incorporate that support of the larger system on the smaller. And likewise, we will look, if it's that tight of an agreement, even if they're not, you know, totally one NewCo, we'll look at what the credit impact would be to the larger as well.
Yeah, great. That's helpful. I think maybe what we'll do is I'll turn it back to Lisa and she can talk about some more general industry trends.
Yeah. Let me just follow up, if I may, Robert, though, on one point. Yeah. Eva, question for you. You know, scale, size, a big part of Moody's approach. Can a system be too big to fail? What do you think?
I don't think rating agencies are allowed to say too big to fail, Lisa. Yeah, I mean, look, there are very clear advantages to size and scale in this operating environment. Whether that means you're too big to fail, you know, I won't go there. I think you know, we've seen crazy things out there in this world, but I do think, you know, the underlying assumption is that there's still benefit to scale and size.
Yeah. Okay. Susie, Kevin, any thoughts on that? Fair question, fair game.
Mm-hmm. It's interesting, too big to fail. And I was like, what does that mean? Does that mean that you won't get a downgrade or outlook change? No, you can't be too big, because we've seen that across different credits. And there's a sense of essentiality of these services, right? So you could see divestitures and things of these bigger systems that maybe, you know, and we're seeing that a little bit, and we've seen places close, and we've also seen other systems where no one's stepping in to help, where there maybe it's an overbedded community. And so right. I think just depends, but.
Okay. Unlikely to fail. How's that? Maybe we'll just go that far and leave it there.
Very good. Okay, fair enough. Thank you for everyone's candor. Susie, let me turn to you. Back to your recent report, you listed FEMA as a potential stabilizer. Are you seeing hospitals receive FEMA funds, or is it still, you know, in process? What's been the trend?
Yeah, and just to clarify, I think it would be a short-term stabilizer, not something that's going to help everyone out of this, but just some additional money. I don't think it's at any of the levels that we've seen for the COVID-19 relief fund. So it is like just a short. Maybe it helps to avoid a covenant issue. Maybe it helps the balance sheet a little bit. Just a little extra support. I think it's still, we're still hearing more that it's coming, that it hasn't. Okay. There are some dollars that have flowed, but there's still more coming towards it, or not more, but I should say they've put the applications in. It's just taking some time to get through it. So I think we may see a little bit more at the end of the year, or maybe even 24. But again, I don't think it's like a game changer. It's just maybe helps a little bit in the interim period.
Got it. Do you find that most budget for FEMA dollars, or it's gravy, if you will?
Yeah, no, I don't think anyone's budgeting for.
Okay.
FEMA. Yeah.
Okay. Let's talk about labor. Kevin, I know your team has done a lot in this area. Can you share with us what trends you're seeing of recent, and maybe what some of the more effective strategies are that you're observing?
Sure thing. So I think all of us probably ask really the same questions, but when we get in front of an issue or a credit, you know, we're asking a lot of the issues that are top of mind, which is, look, labor costs so much; it's the biggest expense you've got in the system, and so where is it? And then we spend, if I had an hour with someone, I'm going to spend probably 35 minutes now talking about labor. So talk to me about how much external contract labor you're using ECL. Is it coming down or not? Generally speaking, the answer is yes. The number of units I'm using is coming down, in some cases dramatically, in other cases not so much. The next question is, well, what's your cost per that unit? And so, at its peak, we all heard egregiously high numbers of per hour, unit of cost for a specialty RN. I've said this many times. The highest I personally heard was $350 an hour, which, as we all know, is simply unsustainable. But that number too has come down. I will say it has not come down to crisis levels, maybe for lack of a better word, but it's come down to levels that are far more manageable and less egregious than we saw. I think another thing that we always ask for is what's your hiring looking like? So are your net hires better or more than your net leavers or terminations? I would say also that answer is generally yes. Some people, the slope is very steep, others it's kind of flat, but we see that. And in terms of strategies, I mean, it's everything, and there is no one strategy that works for everybody. So you can't see me because my video's off, but one thing that I would say that everybody is doing is a good strategy is widening that funnel. And so they're looking not only further abroad, but also at maybe other job classifications that might also be good fits for, but we haven't traditionally thought of those individuals to come into the system. And at the same time they've widened the funnel, they've also shortened the funnel, meaning you don't get caught up in HR for 4 months. We think you're a great candidate, you get a lovely resume, you come in for 12 rounds of interviews before now it's you've got a great resume, we'd like to hire you, you're hired. Boom, 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 boom. So widen the funnel, shorten the funnel. But I think, some of the more interesting ones, I think of like Palomar Health and Diane Hansen out there. They had a 3-year contract, $100,000 signing bonus. Mostly backloaded. I don't have the exact numbers in front of me, but something that's bold. That's a big, as we used to call it in grad school, a BHAG, a big, hairy, audacious goal. That's a big, bold move. That's not going to be right for everybody. But is it working, wonders for Palomar? Absolutely, it is. Other people are at the high end of the market. Other people have said we're making agency and external contract labor the bad guy. We don't ever want them in our house. Some people are doing gig labor, internal pools. So anything and everything you can think of, I think people are trying and using. But I would say there's no one strategy fits all. So that's a lot of talking about labor, and I'm happy to answer more questions about it.
Yeah, no, that's great. Susie, Eva, anything else you're seeing that Kevin didn't chronicle on labor?
Nothing on, I think one of the questions I also ask is like, as you look forward, the salary increases that you have to put in, are they starting to kind of get normalized? And some have different answers to that. Some are like, nope, we're still doing 6 to 7% increases. Others are no, we're more 2 to 3% back to something. So we ask that too, because I think that's going to affect the future cost structure. And I would agree with all the sort of efforts to combat this. It's just everything, under the sun that you can think of.
Okay. Eva, let's try and turn off your mute so that if you're on, we can come back to you on the labor front. Kevin, just as the industry works through labor, Fitch had made a prediction or a forecast that the industry would trend toward break even, not for the full year 2023, but as the year progresses. So from your perspective, what are you seeing in regard to that forecast?
Yeah, I think we're still sticking to that. So we did make a draw line in the sand, if you will, and we said we thought in 2023 most of our rated universe would hit break even or better on a month-to-month basis. Lisa, you're spot on. It may not mean that your audited year is still better than break even, depending upon when you hit break even and when your audit year ends, basically. So you might still show a negative operating margin, things like that, but you'd be on a month-to-month basis positive. I think it's still going to happen. I think at a slower pace than what we had expected. So the slope of the curve is maybe a little bit flatter than we were anticipating. But also shout out to Kaufman Hall and the flash reports. I think the data that you guys gather is starting to show that as well too. We've seen, I think, 3 of the last 4 months been slightly above break even, and I think that's anecdotally the same kind of thing we're seeing as well too. Not for everybody. Obviously, there's still a portion of the portfolio that's struggling. That's that portion of that portfolio we keep talking about. We're seeing downgrades, right? But everybody else is getting nearer and nearer, if not surpassing that break even level in 2023.
Okay, great, great. Eva, are you back? Let's do a sound check. No? Okay. We'll try and get Eva back. Susie, in regards to, performance trending to break even, but I think we will agree we're still at a lower level. How are hospitals thinking about capital spending and borrowing if performance and cash flow is going to be lower for the foreseeable future?
It's mixed. I mean, there's some places that are moving ahead and have issued some debt and are continue on projects that have been in the works for a number of years. And we don't advise, right? We credits have to do what they have to do. We like to know what the off ramps are, what some of the flexibility they've built in if things go one way or another way. So we just want to know more. Well, and sometimes that project, it could be it could affect the rating, and taking out that debt at this time, it could, and so that's just a factor that we've always said you got to do the right thing for your organization. And so sometimes it affects the rating and sometimes it doesn't, but I think we are hearing different things on those projects. Some are still maybe pushing out a debt issuance as interest rates are going to stay higher. Yeah. So I think it's a lot of mixed, it's very mixed in terms of what the different strategies are and the different approaches on it, but we've had some that move forward, some that are maybe slowing it down again based on kind of what they're seeing right now.
And Susie, how does a rating committee view another slowdown, say, in capital spending? I mean, at what point does the committee say, you're really behind the capital 8 ball? What do we do?
And it probably depends on the market they're in and who they are and the competitiveness of that market. So if there's other things going on, that could factor in. So, but yeah, the longer you delay, it starts to, it could affect, our view of kind of the balance sheet, because at some point spending is going to have to start up at, so.
Okay. Eva, I think you are back. Can we get an audio check? Oh, great.
Yes.
Okay, great to have you back. Any thoughts from your perspective on, as we were just talking about, capital spending over the foreseeable future? And then maybe you can give us a bit of a preview on perhaps medians and what you expect to see.
Sure. Yeah, I mean, I echo what Susie said about pursuing the strategic projects. A hospital needs to do it when they need to do it, regardless of whether there's a downgrade. That downgrade does not say that it's a bad idea. It just says it puts you in a different risk profile relative to where you were before. And I agree that you can't forestall spending forever. And I think if we're looking at, a highly competitive market and low capital spending over the years and higher age of plant and very low cash flow, then that could be a pressure rating or a negative outlook. Just thinking strategically, is this entity going to be able to keep up with what it needs to do in order to stay effective in the market? So there's that on capital. And then in terms of medians, I think we were pretty clear in our preliminary medians that came out in March that we don't expect things to get better for the full year medians. Obviously, we all lived through it. September and December were surprisingly bad quarters, and the nose did not pick up. So I would say our median operating cash flow was 5.2%. In those preliminary medians. It will probably hover around there, maybe a little less for the full year. And the cash days cash was 210 days, and that put everyone at about 219, the level of 2019 rather, so pre-pandemic levels. And I think there's been some erosion. I think that, the medians for the full year will show that through the September, December. I think that it hit cash fairly hard. So my prediction is those will come down modestly. And then just to kind of circle back to what Kevin was saying, that through the year, more people trending toward break even. I think that we are definitely seeing a persistent, 16 to 17% of our portfolio with less than 1% operating cash flow. And that is just astounding. It's a totally different environment. I think that will shift over time? Yes, absolutely. Is it shifting around the edges as your reports show? Yes, absolutely. But I do think that's kind of important information and context to keep in mind, that it's still that's a material portion of the portfolio.
Right. And so for that group, that is a big number in a very small way, right?
Mm-hmm.
Are they pulling back on capital spending in particular?
I think there's for most, yes, in that group, yes, I would say so. Not all, it's not exclusive, but yeah. And I think it's not the same. What's interesting is there is some movement around the edges. Maybe 5% of that shifts in and out of that below 1%. So it's not every quarter it's the same credits. Every quarter it's a big chunk of the same credits, maybe 12% of our portfolio, but others are dipping in and out of that low cash flow.
Got it. Okay. That is a wow number. So Robert, let me head it back over to you.
Great. So we've got about 5 minutes left to just talk about rating meetings. I'm sorry. Several years ago, we talked a lot about COVID. We've sort of come and gone now, I think, past that. I guess I'd be curious to hear you each talk a little bit about, what you want from a rating update. What does a good presentation look like now relative to a year ago? And maybe just, what are you hoping to hear about? And Susie, maybe I'll start with you, and then Kevin, and then we'll go to Eva last.
Yeah, I think starting to understand, seeing where things are headed. Obviously we want to kind of understand what the current context is, but on the labor front, but to the extent that your budgets we want to see your budgets and forecasts. I know 2 to 3 years would be good to get. What the capital plans are. We still like the waterfall of how you're getting from, this to this. We love those waterfall graphs, so keep them coming. So, and providing some details around those performance improvement plans and synergies or whatever it is that you're expecting, and giving us ranges is helpful. And the covenant details that we talked about earlier, having that one slide in the back is just, it's really helpful to us. And finally, the capital plans, and where the levers are on those, and what can be pulled back, what isn't going to be pulled back. I think those are some of the key things I think that we'd want to see in those presentations.
Great. Kevin, anything you'd add to that?
Well, I agree with everything Susie said. I'd say, first and foremost, make it a dialogue. Open and honest communication is something we certainly value. We want to hear the story. And I think I keep saying this. I think, two things. One, much less focus on COVID and the COVID numbers. We don't really need to hear a whole lot about that anymore. I think we're sort of beyond that. But something that we've been losing, I think, in the last couple of years with the financial difficulties with that subset that we've all been talking about is, what do you want to be when you grow up? Give us more of the strategy, and that's that story behind who you are. Let's not lose track of that when we're talking about stopping the bleeding. Let's also say, we know it's going to stop at some point. Now, what's your next big strategic moves? What's going to happen there? Tell us that story as well, too.
Great. Eva, anything you'd add?
Yeah, I guess I would just wrap it up to say, certainly strategy, definitely forward look, levers, and sort of guardrails. Like what is your tolerance and bandwidth for certain things? If you're, what will you do if you have, you don't make your operating cash flow margin that you're projecting? What will you do if labor's, give us the guardrails and your off ramps, if possible.
Great, thank you. And I'll just take this in reverse order, Eva, maybe first with you, then Kevin, then Susie. Give us a minute on how you prepare for, a rating committee. What's your process?
Yeah, I mean, it's a long process, read through all of the last reports, the last rating committee package, last issuer meeting notes, last audit, quarterlies, et cetera, come up with your questions on the recent trends and kind of current events, then compare the scorecard of this time versus last time and the comps this time to kind of highlight specific areas you want to talk about, where the entity might be exceeding expectations, where it needs needs improvement, to use grade school words, and then send those questions over. And always we try to include internally at least a little discussion beforehand if there's anything that is thorny or out of the ordinary with the credit.
Great, thank you. Kevin, anything you'd add?
I was going to say, well, Red Bull and nachos, that's how I prepare. But no, in all seriousness, no, everything we just said, we're looking for those gaps, right? So when we don't have an answer to a question, there's sort of this blank space that we're thinking about what happened here, what are you going to do about this? So that's what you're really trying to identify. So prepare, but really with an emphasis on filling in those. I can't possibly know the answer to this question until I ask it to you. That's what I'm really focused in on.
Great. Susie, any final thoughts?
Yeah, agree to all of that. I think we also talked to other, analysts that work in that regions, just to kind of get a sense of what's happening in that market. And we look to, maybe even our higher ed analysts, if it's an academic medical center. So and on the past primary, the past backup. So agree with everything that Kevin and Eva mentioned, and just a few other things that we do.
Great. Listen, I want to thank you, each of our panelists, for being here. I want to thank our friends and colleagues that have joined us for the presentation. Jim, I think I'll turn it back over to you for final thoughts.
And thanks again to our panelists and to all of you for attending today's webinar. Look for an email with a link to a recording of the webinar within the next day or two, and we hope to see you at our Healthcare Leadership Conference in October. Thanks.
Thanks all.
Thank you. Thanks.
Thank you.